So if you're looking to sell your home and buy the next one, but you're worried about how you're gonna make all those numbers work, and what if your house can't sell on time? This video is for you. So I am your local lender here in Charleston. I am licensed in North Carolina, South Carolina, and Florida. And today we're gonna talk about bridge loans and HELOCs and how they work. So with a bridge loan, essentially what we're doing is we're taking your current house that you own. You do need to have a good amount of equity in it, typically over 20%. We're gonna go ahead and front load that equity for you and allow that to bridge over to your next purchase without you having to sell the home immediately. You will make interest-only payments on that money that we're moving over to the new house for you out of your equity, and you'll have 6 months to pay off your home. So you may be thinking, why would I want to do this? Well, a couple things. Number one, you don't have to sell your house immediately. We're definitely seeing longer days on market, and if you have to put in an offer that's contingent on you selling your current home, that could risk you missing your closing date or your offer being turned down because it may appear risky to the sellers. So you get a twofer there. One, you can go ahead and move that equity over without having to sell, and you get that time, so it takes away some of the stress where you have your 6 months to sell. And two, you're now able to put in an offer that is not contingent on the sale of your home, which makes your offer stronger. So let's look at one scenario where a house is already paid off. Let's say we have a house that's $400,000 and it's paid off. We take $300,000 out as part of that bridge loan. That's the equity we're gonna go ahead and bridge over to the next purchase. Let's say you're buying a $400,000 house again. You have $300,000 that's immediately coming over from that equity, and then you're gonna add in the other $100,000 from, let's say, stocks, bonds, IRA, 401k, or liquid assets. That's going to make up the full $400,000 for that new home, and that allows you to sell your home in 6 months. You don't have to worry about selling it immediately. It also allows you to technically put in the equivalent of a cash offer on the next home that you're buying, which sellers are more likely to take because it's less risky for them. Now, let's say your house is not completely paid off yet, or you don't have $100,000 sitting around in other assets. If we take that same example, let's say we take that $400,000, let's say we can pull out $300,000. So we still need $100,000 to get to that $400,000 mark. You can also do a bridge where you pull over part of the equity and the remaining amount that you need goes into a traditional loan. So in this case, let's say we pull over the $300,000, we have $100,000 that we're now gonna put into a regular 30-year conventional mortgage or VA mortgage, whatever it may be. And that gives us the $400,000 for the new house. You're still able to put in an offer that is not contingent on the sale of your home. You still have 6 months to pay off the other home by having it sold, and then you're only making interest-only payments on that bridge loan and your regular payment on your new loan. So who are bridge loans really a good option for? Number one is individuals with really good credit. Not every bank offers bridge loans, we do thankfully, but most who offer bridge loans will have a higher credit that's needed. I would say you're going to be expecting at least a 700 or up for your credit score. You do need to have a low amount of debts because we do need to make sure that we can fit in that interest-only payment along with possibly a new mortgage if you need the new mortgage as well, and all your current debts. And you do need to have a good amount of equity in your home. So this is typically someone who's owned their home for maybe 5-10 years or so, and they're finally ready to sell, but don't want to go through all the hassle of having to sell immediately and all that stress. So it's good if you have good credit, low debt, and a lot of equity. Another product we always tell sellers about are home equity lines of credit. This is essentially taking a credit card from your equity, and you can continually take more out, or you can take one lump sum out in the beginning. What this is great for sellers is for doing renovations to your home. So let's say you want to be able to list your home for $500,000, but based on the condition, you can only list it for $425,000 or $400,000. You could take out a home equity line of credit if you have enough equity and go ahead and do the improvements like replacing the roof or the HVAC or the flooring or updating the kitchen that brings you up to that sale price you really want to sell it for. And then when you sell the house, you'll have your proceeds and that HELOC is paid off. So that's a really great option to help go ahead and do some of those renovations up front so you don't have to come out of pocket and can hopefully get the most for your home. So again, if you're looking to sell your home, you've got two really great options out there that we do offer. You've got the bridge loan to remove that home sale contingency and go ahead and bridge your equity over, or you've got home equity lines of credit if you need to do renovations to the home. That way it's ready to sell for more. If you have any questions, feel free to send me a message or reach out.